The dollar is in danger, dropping to 3-year lows with tariff concerns weighing in on the greenback. We've got another busy week with a couple of key central bank decisions from the likes of Bank of Canada, the ECB, and a number of high impact data points. How's the dollar and its peers going to react? Guys, Ken Chigbo back with another E8's market fundamental update. This one's going to be juicy. Let's jump straight into this. So guys, the dollar has dropped to its lowest level. Look here on the chart. We haven't seen these levels since April 2022. We've come under a heavy amount of selling pressure, and it goes back to what I said those weeks ago where I warned you, right? I said how the dollar, when we were heading into this tariff announcement, the dollar was just likely to be on the back foot. There was on the back of it, there was no positive scenario for the dollar, because if the tariffs weren't so bad, we would have seen risk appetite. Riskier currencies would have been rallying. The dollar may not have got hit as hard as it has lately, but then obviously these tariffs have been announced. They've weighed heavily on the dollar. It's made it that narrative that we've been going with, right? That how the dollars or the United States has been seen as uninvestable. These tariffs, because they're creating so much uncertainty, we're getting large outflows from the United States and inflows elsewhere. People don't want to be invested in the United States right now because of how volatile it is with all these tariff announcements. And look, Trump did in the latest week, which promoted a little bit of risk appetite, but it's short-lived. Trump did announce a pausing of those tariffs on the other countries, but except China. Okay, China's the only one. They raised the tariffs over 120%. Same with China. China retaliated with the same sort of level of tariffs. So it's this full-blown trade war that we have yet again, but that we saw previously in Trump's prior presidency, where we've got the two largest economies going head-to-head with trade wars. And I said to you before, as with any war, okay, any sort of war, and obviously this specifically trade war, no one wins, because it's crippling. The tariffs that Trump's announced on Chinese goods is crippling for US businesses. If it's crippling for US businesses, costs are going to go up. Businesses potentially, then obviously consumers are going to be more out of pocket, but then eventually it may not make sense for that business to carry on. Okay, they may have to make cutbacks, and if there's cutbacks, then they're going to cut back on labor force potentially. It's more unemployment rising. You see how it's a chain reaction, it's a domino effect, and obviously, you know, it doesn't just bring down the US, it brings down China, and obviously likewise the same situation with them. And then, of course, everyone does business with the United States. People do business with China. If we've got the two largest economies crippling and contracting, it's going to have a domino effect, guys. Okay, this would, if I carry on talking about this and in terms of the repercussions, we'd be here all day. But just know that it's creating a lot of market uncertainty, which is why the dollar's been hit really hard. Is, as I said before in a previous video, it's lost its safe haven status. So if you look here, the big development was, for me, was obviously I was targeting this psychological 100 mark, okay, around 150, and you can see a big breakout to the downside there. And when you look left, the next major demand zone is seen at 98. Okay, that's the way the dollar index is heading now, given this uninvestable narrative that we're running with and the vulnerabilities now with the US economy, because no one knows the damages, but we do know that it will be painful, you know, and it is going to potentially take its toll if it carries on this way. Now, if we look this week in terms of the dollar, we're going to keep an eye on retail sales. Okay, retail sales due out on Wednesday, which are expected to, okay, surprisingly be quite healthy. I mean, the US economy is still performing well. We are seeing some signs of cooling. Labor market's obviously been cooling. Inflation, by the way, let's just quickly recap last week with inflation. Look at this, it's important to note. Inflation's cooling, okay? Price of goods and services coming down. And it doesn't fit with the narrative where we are just seeing easing in the US economy. The gas is coming off a little bit and we are cooling down. You know, we've seen a couple of back-to-back readings as we've gone over with the NFP, with unemployment rate, wages all coming down. And if those are coming down, I wouldn't be surprised if we just fast forward into this week. Excuse me, guys, let me just pull this up again with those retail sales numbers. So this week, come on, Ken, what have you done here this week? So with those figures on Wednesday, I wouldn't be surprised if these are softer than expected. And if that proves to be the case, it's only going to add fuel to the fire to that dollar downside. Let's also not overlook this. Powell's going to be actually speaking on the economic outlook on Wednesday as well, Wednesday evening. And given all these developments, there's a lot of uncertainty. Inflation's cooling. Perhaps we could get him striking a bit of more of a dovish tone, okay, warming up to the idea of rate cuts incoming. now that inflation is, especially on an annualized levels, really coming down closer towards their target of 2%. So we could get a dovish tone there, which would also add fuel to the fire of that dollar downside and market ramping up their rate cut bets from the FOMC. So this week, especially given that weekly closure there, even on a daily, I'd like to still see some more downside, and let's reevaluate once we potentially hit that 98 mark. But dollar remains vulnerable, guys. The euro, we do have volatility as we've got the ECB rate decision due out on Thursday. Now, these guys are expected to cut by 25 base points. That is like more or less 100% priced in. The key with the euro is dependent on Lagarde's tone. There is possibility that she doesn't she isn't as dovish as the markets want in terms of talking about more rate cuts, because inflation in the Eurozone is cooling. And remember, we had that boost as well with optimism and investor optimism as well, that over 500 billion euro package being announced by Germany to boost that infrastructure in the economy. Obviously, Germany's the largest economy in the Eurozone. So remember, that was inviting a lot of inflows into European stocks, and obviously that's good for the overall Eurozone economy when more money's coming in like that. For me, given that inflation's heading in the right direction, I think with the ECB, especially given those pausing of tariffs from Trump, okay, I think the euro is stable at the moment. It's still it's relatively stable. Obviously, we had the fears of stagflation, but I think those stagflation fears are subsiding a little bit. Obviously, Lagarde's still got to be cautious on the outlook of tariffs, because if China and US are going at it, it could still have an impact on the overall global economy, okay? So there's be an element of caution there, but I don't think she'll be as dovish as what the markets want, just given the progress that we've made with inflation and how we've sort of stabilized a little bit. We've had the stabilization with Germany, the big stimulus package. I think euro, and I've been noting this quite a lot lately, how euro, you know how we have our traditional safe havens, traditionally, right? Dollar's obviously up there with yen and Swiss franc, but if we remove dollar from the equation for a moment because of the uncertainty, the uninvestable narrative, yen and Swiss are safe havens. But euro historically has been one of those that's just outside of the traditional, and euro has been a safe haven as well, because we've always had that support of the ECB. They've always been there to do whatever's necessary to protect the euro. So I think euro's maintained a bit of a safe haven status and still got that boost from the stimulus package, in my opinion. And you know, when we look here on the monthly, obviously on the flip side to the Dixie, incredible upside we haven't seen since January 2022 here, these sort of levels here. It's incredible. Big bull run. We've run into obviously some supply around 115, but the way the weekly is right now, it's incredibly bullish. I'll be surprised if we start reversing. Okay, especially here with the daily, nice big bullish candlestick. For me, if we look left, the next major, it'd just be working into our next sort of zone, which would be up here, in my opinion, around the mid 116 region. So I'll be monitoring for potential breakout retests, get comfortable here, bam, 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 and running towards 116.50, 117. On the 4 hour, we had a bit of a pullback after running into that heavy supply. Perhaps we consolidate a little bit, try and break out from this flag and push to the upside. That's just a potential scenario, in my opinion. Obviously, it's not financial advice. That's just a potential play there in my eyes that I'll be looking at for euro. But I expect a not so dovish as much as what markets would want for the euro, which for this rate decision, which would be obviously be supportive of euro upside. Plenty of volatility expected with the Canadian dollar, because we've got the Bank of Canada rate decision and we've also got Canadian CPI. Now, with the Bank of Canada, it's a bit of a 50-50 when you look at general expectations. Overall, it's just edging for unchanged at 2.75%, but there are a lot of calls from analysts for a 25 base point cut. So either way, because it's like a 50-50 coin toss, more or less, whatever happens here would be, obviously, if they do cut, we'll see a lot of CAD downside. If they keep unchanged, we'll see some CAD upside. So let me make that clear. If they do cut, there'll be CAD weakness. If they keep unchanged, there'll be CAD strength. Now, obviously, one big thing heading into that is CPI. Inflation, look, if you look at the prior readings, remember they ticked higher. Okay, inflation's sticky in Canada. Look at that. So they kind of had this situation of stagflation where growth has been slowing down in Canada. It has been pretty slow, more of a miss in terms of GDP figures. Growth is not there. Inflation's quite sticky, but I think these guys will want to be focused on bringing down those inflationary levels. So if this CPI really shape up tone and sentiment for CAD heading into that rate decision on Wednesday. So that is really the decider, in my opinion. If these numbers are still high, i.e. in line, or even higher, you can expect the Bank of Canada definitely to be unchanged with rates, which we'd see a lot of CAD strength, I believe, right up until that rate decision. Okay, obviously, if it cools, it's still going to be a bit of a 50-50 scenario because it depends how much it cools by. When you look at dollar CAD, right? So that's going to really shape things up, guys. So keep locked in on that on Tuesday. If you're looking to trade CAD, please, please, please don't oversee that. Now, if you look at dollar CAD, we've come down to a very key area here. If you look around sort of 138.50, 138, look, this was a former top for ages. Look, big rejection since October 2022. Bam, 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 bam. This is a forceful zone. So it's going to take something significant, i.e. this CPI, that to be hot to run through this zone. It'll be like bam, bam, and we will cleanly look. You can see every time we've rejected here, we've come all the way down. Okay, down towards, back towards 132s. Okay, more or less. Okay, here we came down here, but you just have to play it by ear and just see how the price works sort of zone to zone. It could be a case of that, or we could bounce there. But either way, if those numbers, if those numbers substantially call, it needs to substantially call, and obviously we'll ping off this zone and head back towards the next major area, probably be 141, heading into a psychological 141 area. So keep locked in on that CAD data and of course the rate decision. The Aussie dollar, we do have key labor market data from Australia. It's important to note because, you know, markets want to keep ramping up rate cut pricing from the RBA. You know, we know they did shift in to a more slightly dovish tone at last decision because the labor market has been softening. Inflation is heading closer towards their target. Obviously, last employment change was poor. Look, we had minus 52.8K, which was bad number. Unemployment rate did remain steady at that previous reading, but this one we're expected to tick higher to 4.2%. Okay, if this data does soften, then of course it's going to ramp. Market's going to be ramping up their rate cut bets. There's a lot of sensitivity with Aussie dollar, right? Because obviously what's going on, this trade war between US and China. Remember, China is Australia, is their biggest two-way trading partner. Anything negative that happens to China is negative for Australia as well, because it potentially means China could make cutbacks on commodity purchases and trade with Australia, right? You see how it makes sense? That's what I mean about that domino effect. It doesn't just affect US and Canada, it affects everybody, you know, everybody, because of that domino impact and that interconnection. If we look at Aussie versus USD specifically, obviously structurally we've still been very much to the downside. We've had this massive pullback though on the weekly because of those tariffs, the fact they're being postponed, and obviously just on the, well, not China but everybody else. But then this has just been benefiting from a bit of risk appetite. But I think you've got to be cautious with Aussie in general versus other peers. You know, when you look at likes of perhaps GBP Aussie or Euro Aussie, like you have to be careful because the vulnerabilities there for Australia are linked to China. But if we're just, obviously as a base case, I'm just talking about Aussie dollar right now, big bullish candlestick there on a weekly, big bounce back from this heavy demand zone around protecting 60, essentially protecting 60.00. We've pushed back into this range. See this range, this channel that we broke out of, we're back into it. If that data does come out better than expected, you can expect us to just push to the upside in towards this next major zone. And basically what you could do is just extend out this. You see this channel, this trend line, and you can see we're just back into that structure, and we'll come back up towards close towards 65.00. Obviously, if the data on Thursday, and again, obviously it depends on the dollar, what the dollar's going to be doing on Tuesday and Wednesday with those key events. But obviously, if the dollar somehow manages to regather some momentum and this data disappoints, obviously you can expect rejections up here, probably just be a big rejection somewhere like here, or maybe a fake out, and then we'll come back to the downside. But I'd be very cautious trading Aussie versus the dollar because of the mixed sentiment, and because obviously dollar's also vulnerable as well. So it's a bit of a tricky one to trade right now, but there are other currencies versus the dollar, versus the Aussie dollar, excuse me, that you can look at, but expect some volatility there as well. And GBP, we do have some key data from the UK, labour market data and inflation, which are important. Let's just quickly note, last week, by the way, surprisingly, the GDP number from the UK on Friday came out higher than expected at 0.5%. Remember, we have been worried, general economic concerns around the UK in terms of stagflation, where growth has been low. Remember those previous numbers that we've looked at? They haven't been great at all, more missing those expectations and hitting a higher number, and previously even revised higher. That previous number, we had a contraction of minus 0.1, and number getting revised higher to 0. This week, we're going to be keeping an eye on labour market figures. Okay, we've got the claimant count change, amount of people claiming unemployment benefits, and we've got the UK CPI, which is very, very important, because it's obviously markets are trying to figure out when the Bank of England are next cutting rates, because they've been on pause, right? In comparison to other central banks, they've been on hold. Obviously, if inflation cools, that's going to ramp up rate cut bets, and we'll see pound weakening. If it remains steady at 2.7%, Okay, in line with, in line with forecasts, because that's still sticky. Remember, they need inflation down at 2%. If we don't see it cooling fast enough, it's going to provide GDP strength, because markets just be like, look, these guys are keeping rates high for longer. They're going to be on hold. When we look at GBP versus the dollar specifically as our base case, again, obviously on the weekly is a very good performance after last week where we, last few weeks, 1, 2, 3, 4, we've just consolidated. And you could almost view that as a bit of a bullish pennant, bullish flag there. Here's all of our pole, and here's the breakout now. And obviously we could go and extend and go and challenge these highs that we saw here in 2024. Now, if we break things down firstly on the daily, we need to break down this top area here. One significant thing for the pound, which GU, is the fact that you see how we'd broken this key trend line, had been in play, been supporting the price to the upside from the start of this year. We broke through that and we sucked back above. So that's quite significant for me. It's almost essentially a bit of a fake out, right? So we've sucked back above that and we're still respecting the structure. We need to go and clear. I think this would present an opportunity potentially, in my eyes, breaking, retesting here, this top around the psychological 131 area. And then we can make our way, go and fill this wick, go and challenge this high here at 132. See how we deal with 132. If we get comfortable here at this zone, we could just, case of working zone to zone, capitalizing still on that dollar weakness. And remember, the UK isn't exposed to all this tariff nonsense at the moment directly as well, which is good. So if we do get a sticky CPI number and labour market figures remain relatively stable, it will ramp up, it will push back market rate cut bets from the Bank of England and support GBP to the upside, especially not just versus dollar, versus other peers as well. Okay, there are other data points as well this week. If we just sort of look as a quick overview, things that I didn't talk about, I'll just quickly touch upon this week. Okay, in terms of high impact stuff, there's New Zealand as well. We've got New Zealand CPI, which is worth noting. Obviously, the central bank RBNZ have been cutting rates quite consistently. Obviously, the US weekly unemployment claims, again, just be good to understand where that's at, see if it feeds into the narrative that US economy is cooling. If we see those numbers ticking higher, they've remained generally sound, to be fair, which, is pretty resilient. The fact that unemployment claims haven't really been ticking higher, but let's see as well. So another week anyway, guys, filled with volatility, and obviously we're still going to have all the headlines and news developments around tariffs anyway, particularly more so China, US versus China. So things are exciting right now. There's a lot of volatility and lots to potentially capitalize on. You just got to keep your finger on the pulse and be nimble and agile with these ever developing fundamentals and macros. Other than that, have an amazing, blessed week, and I'll catch you on the next video.